everyone, Angie Gerrard with Angie Home Loans and NEXA Lending, and welcome back to the Real Estate Investors Loan Series. Today, I'm excited to welcome John Sperling with Vizio. John is one of the country's top DSCR producers and has helped countless loan officers and investors understand these programs. John, thank you so much for being here.
You're very welcome.
Could you tell everyone a little bit about yourself and your experience in DSCR loans?
Sure. So I've been with Physio Lending since 2013, really at the beginning of the company when we started doing third-party lending. We started doing hard money, small ticket hard money loans. 2015, we rolled out the Rental 360 DSCR loan. So we were essentially the granddaddy of DSCR. We were doing it before anyone else. We've done more of it than anyone else. And we're a specialty lender. We don't do any other types of loans. We only do DSCR 1 to 4 unit residential. And in that time, we've closed about 20,000 DSCR loans, of which
Wow.
I've closed over 3,200 of those. So there's not a lot of scenarios in DSCR that I haven't seen over the years. We're a nationwide lender. There's very few states we don't lend in. And yeah, I mean, we do long-term rental properties. We also pioneered the short-term rental Airbnb loan product for
Oh, wow.
investors. So when it comes to DSCR loans, really, as far as experience, there's no one close.
That's incredible. So for someone who's never heard of a DSCR loan, can you explain kind of what they are and how they work?
Sure. So DSCR stands for Debt Service Coverage Ratio, and that's really just a fancy way of saying rent divided by PITI, right? So instead of verifying a borrower's personal income to justify the payment, we're going to verify the market or actual rent of the property and whether or not it covers the proposed payment on the loan. So think of it this way: we're substituting the rental income for the personal income to make the loan work. So essentially, the qualifications are credit, loan to value, and debt service coverage. So it takes out all of the employment verification and income verification and tax returns, W-2s, pay stubs. That's all gone, and we're simply looking at the property. Does the property at least break even the payment? So we don't even require it to be a 1.2 or a 1.3. We require it to be a 1.0, which means if your rent is 1,500 and your payment is 1,500, that's a 1.0 DSCR. The loan qualifies. So it's a property level loan, right? Does the property make the payment for you as long as the rent is paid? So that's in a nutshell. Debt service coverage ratio equals rent divided by payment.
Okay. And so what you had mentioned, the other guidelines, what would be some of the minimum credit scores?
Right. So we're really an Alt-A lender, as we used to say back in the day. We don't lend to anyone sub 680 FICO. Our average borrower has very good credit. Our average borrower probably has a 750 FICO. We work with both new investors and experienced investors. We don't have experience requirements on long-term rentals. We have some experience requirements on short-term rental, but they're minimal. It's not a very high LTV loan. The max LTVs are 80 purchase, 80 rate term, 75 cash out. So, it's not like an FHA loan where someone's going to come in and buy a rental for 3.5% down like their primary. This is a different world. And legally speaking, it's considered a business purpose commercial loan. So it's
Okay.
outside of RESPA, TIL, TRID, all the consumer loan regulations, compliance features. We're outside of all that.
Okay. That's good to know. So you had mentioned investor experience.
Mhm.
What do you guys look for when you are looking for that experience? How do they provide that?
Right. So if it's a long-term rental, there's no experience required.
Okay.
So we don't look at anything. If it's an Airbnb, we're looking for 12 months of mortgage history within the last 3 years, but it doesn't have to be investment. It could be primary. So someone owns their primary for 3 years, they're paying their mortgage, it's on the credit report, they want to buy their first investment, it's going to be an Airbnb. That's fine as long as they have some history of making a mortgage payment.
Okay. Okay. Well, that's good to know. So what makes someone a good candidate for a DSCR loan, or who are these best suited for?
Right. So, everything from I'm buying my first rental to I own 200 and I'm looking to add 50 more. So the problem with Fannie Freddie and the investment loans there is obviously they're full doc. You cannot close in your LLC partnership or corporation, which most of the loans we close are within an LLC partnership or corp.
Okay.
Um, if you get 10 loans on your credit report, it's going to kind of affect your FICO score. We typically don't report loans to credit. So, when you have, let's say you have a borrower who owns two rentals and they want 20 and they want to use leverage to do that, what are their options? Well, they probably don't have $1 million tax return, so they can't go Fannie Freddie. The commercial banks are not interested in residential lending, right? And even if they did some for them, they'd probably be on a 5-year balloon. Or you go with an alternative product like ours, DSCR, which is really just, is your credit good? Yes. Does the property cash flow? Yes. Do you have the money to close? Yes. Approved, right? So it's just a much easier process and it's built for the way investors behave. Fannie Mae loans are built for the way consumers behave, and
Right.
primarily their mandate is to finance primary residences. Ours is the opposite.
So that's interesting. I didn't know that you guys didn't report to credit. So this would really help an investor that had or wanted to have multiple properties to continue to move forward and reinvest. Okay.
Correct. And they
Um,
want to keep their business and personal separate, right? They're closing in their LLC. They don't want 10 loans on their credit report that's going to mess up their personal financial picture or their FICO score.
right. That makes a lot of sense. I've had a couple questions from borrowers regarding the property cash flow. And I think you kind of tapped into this earlier. But what does that look like? And so tell me if I understand it right. So the PITIA, which would be association dues, needs to
Hmm.
be equal to or less than either the gross or the market rent. Is that correct?
Correct. So if it's a purchase, we're going to go up market rents, period. So if it's a single family, we're getting a rent schedule 1007. If it's a 2 to 4 unit, we're going to have that rent schedule on the 1025 appraisal. So it's going to be market rent on purchase. On refinance, it's a little more complicated. We'll go off usually the higher of market or actual.
Okay.
So we do get the market, we do get the actuals. We can usually use up to 120%. If, let's say, the actuals are lower, you have someone in there 10 years, they're paying below market rent, and the market rent comes in higher, we can use up to 120% of the actuals to cover. And the opposite is true as well. If we have market rents that are less than actuals, we can use the actuals if we get proof of the last 2 months payment. So there's some flexibility there because we
Okay.
understand sometimes you have properties that are rented below market. You have a long-term tenant, maybe they're paying $300 less, and that's going to mess up your DSCR. So we're going to get those two figures and reconcile them.
Okay. So if a property cash flow runs a little short of the new payment, are there things that can be done to remedy this, or what do those look like?
Yes. Yeah. So we offer an interest only product.
Okay.
Okay. So that's typically going to get you about 5% to the LTV. The rate's a quarter higher, but you're on an interest-only payment. And so we're still only requiring a 1.0 DSCR based on the interest-only payment. So that's, if we're just shy, that's the quickest way to skin that cat. The borrower can also buy down the rate. If we're just shy and maybe paying a half a point or a point buy down would help, we can do that as well. In more extreme cases, we do have what we call a no ratio or sub 1 DSCR product. We're going to want better credit. The loan to values are going to be curtailed. So, you see this a lot in California. You'll have $1 million property and the rents are 4K, and the guy wants 650 or 700 grand. That's not going to cash flow to 1.0, right? So we have
Right.
options for those situations as well, but you're going to be at a much lower LTV. So in our world, the only things you can really control for are FICO and loan to value and debt service, right? So there's only really three moving parts to the picture when it comes to these loans.
So there's a little bit of flexibility as far as the interest only and the what did you call it? Sub one.
Sub one, yeah,
Yeah.
under one DSCR, yeah,
Or they can come in with more cash and buy down the rate or possibly put more
correct.
down on the property to adjust those numbers.
Right. I mean, in our world, every loan will work. It just depends at what LTV, right? So, it's at some point the loan's going to work. Is it going to be a 50 LTV or an 80 LTV? That
Okay.
therein lies the rub, right? So, typically we're going to want to look at the property up front. We're going to have enough information to make an educated guess as to whether that property is going to work. So when you're talking to your borrowers and they say, "Hey, Angela, I want to buy 123 Main Street in Joplin. Here's the FICO, purchase price, rent, tax, insurance," we could give them a full blown proposal that gives all of the information. Does it work? Does it not work? At what LTV? And so we do as much of that work up front so that we don't have fallout at the end, right?
So it's really important that they get with their lender up front to try to structure the deal properly to reduce problems down the road is kind of what I'm
Correct.
hearing. Okay.
Yes.
Now, can these loans be used for any type of owner occupy?
No,
Okay.
no, well, no owner occupancy, no family occupancy. So let's say it's a refinance, we pull a LexisNexis and it's a 3 unit property and the guy's sister is living in one of the units. That's a decline. No
Okay.
owner occupancy, no direct family member occupancy. So how we check that is LexisNexis. LexisNexis is pulled and it's going to show relationships and addresses.
Okay.
So if mom is living there, right, it's going to show possible mother living at that address. And so we catch that quite frequently. Um, so you got to make clear that, renting to your son is not a real rental. You're going to evict your son if he doesn't pay the rent, right? So we don't consider that, and the market doesn't consider that a true rental property.
So strictly investment,
Correct.
no family. Okay. Um, what are the typical reserve requirements for these loans?
Yeah,
I
so
know
on a
it
purchase, we're
depends.
gonna, yeah, it's 6 months PITI. So that's really the only financial requirement. We want them to have enough cash to weather, what investors have to weather. Oh, the property flooded, my tenant is out for 2 months while I fix it, or I lost a tenant and it's going to take me a month or two to get them. We don't want them to miss a payment when
Right.
the vagaries of being a real estate investor hit, right? So 6 months PITI reserves on purchase and rate and term. On a cash out refinance, we're going to use 100% of the cash we're giving them towards those reserves. So if we're giving someone 100 grand and the payment's 2,000 a month, they've already got their reserves. We're not going to verify reserves because we're giving them 100 grand, right? So we can
Okay.
use that cash out on a cash out refi towards the reserves.
Wow. Okay. So I've also gotten this question before. Can DSCR loans be used to refinance one of the shorter term fix and flip loans?
Yeah, we do that all the time. So,
Okay.
one of the main strategies is buy fixed to rent as opposed to buy fixed to flip.
Right.
And so, you buy it, you rehab it with hard money. As soon as it's rent ready, we'll come in and do the takeout loan. So we'll come in and do your permanent 30-year loan, get rid of your 12% hard money. Now you're in a 30-year loan, you put a tenant in there, your hard money lender is happy, go do it again, rinse, repeat until you get to the number of properties you want. So, yeah, that's a very common scenario for us. One thing that we don't like very much is what we call failed flips. And so we're seeing this a lot, especially recently. I bought it, I fixed it to flip it. Now I'm done with the rehab. Oops, the market has changed. I can't get for it what I thought I could. Now I'm going to
Okay.
be a landlord, right? So our rule of thumb is if they have it listed for sale, we cannot take an application on that borrower till it's been off MLS for 30 days. Why?
Okay.
Because we want to make sure it's going to be a real rental, right? And over the years, one of the things we found is these so-called failed flips don't perform as well. We've had problems with them. And the reason for that is a lot of these flippers are not landlords. That wasn't the strategy, that wasn't the plan. Now they're a landlord, kind of forced landlord rather than a voluntary landlord, right? So now they're trying to figure it out. So, we want to, we'll do them once they're removed, but they've got to be off MLS for 30 days.
Okay, that's good to know. What are the seasoning requirements on those?
So when we have a 6 month look back, we call it a value review, right? So
Okay.
in the first 6 months of ownership, we're going to use the new retail value right away. So whatever it appraises for, that's our value. In the first 6 months of ownership, we're going to cap the actual loan amount at the purchase price plus documented improvements. So let's say he buys it for 200, he puts 50 into it, it appraises at 400. Well, we're not going to do 75 of 400. We'll give them a loan of 250 because that's what they've got into it, and
Okay.
that's it. Right. So we're not going to, the easy way to think about it is we're not going to give you cash over and above your investment for 6 months. After 6 months, it's just 75 or 80 rate term, 75 cash out.
Okay. All right. So doing this for as long as you have, what type of snags do
Yeah.
you see most often with these loans?
Um, it varies. I mean, it's real estate. Every time I think I've seen it all, something pops up once a week that I've never seen before. Title issues, appraisal issues. I mean, one of the things we're seeing now is, valuation issues. Because, I've been in mortgage for over 25 years. I mean, most people in this business today do not remember the crash. They weren't in the business then. They've never seen a declining market in their career. And so now that you've actually got some flat to declining markets, I'm in Austin, Texas, which has come way off the peak, right? So valuations, investor expectations of what their value is going to be, you know, we always want to look at that property up front. Someone tells me it's worth 400K and I go to Zillow and I know it's Zillow. It's not an appraisal, but Zillow says 280. Well, that's a significant disconnect, right? So
Right.
then I'm going to do a little more research, maybe pull a core logic report, look at the actual last 10 sold comps in the neighborhood. If they're all 280 and this person's telling me 400, they need to adjust their expectations, right? So doing a little valuation investigation up front kind of gets around a lot of that because you have to set the right expectation. I would say the last, meeting we had on fallout, about 30% of the loans that fall out in processing right now are due to low appraisal. So we're seeing, and
Wow.
that's around the country. That's not focused just in one area. So, setting the right expectations around valuations, I would say right now is the biggest snag.
Wow. Yeah, that's I had a meme that came in one time and it showed, what your appraiser says your your value
I know.
is, what the
Yeah, I've
buyer
seen
thinks
that
your
one.
value is, and what the bank
Right,
thinks your, so
right.
they're all very
Yeah.
different.
Well,
Um,
yes.
I have a lot of viewers who are buying their very first rental property. What advice would you give them maybe to get prepared, you know?
Yeah,
Uh,
I would tell them obviously check your credit. Make sure your credit is where you think it is. Um, there's a website called www.myfico.com. Myfico.com. It's very simple. I've used it for my own credit monitoring for 10 years. Borrower actually turned me on to it back in the mid 2010s. And it's the only site on the internet where you can actually get your mortgage FICO score, which is FICO
oh,
Classic,
wow.
FICO's 5, 4, and 2. Most credit monitoring, Credit Karma, all these other ones, that's your FICO 8 score. It's not the model. So most people don't know that FICO has numerous different scoring models
Right.
depending on what type of credit is being extended. So you have an auto loan score, a credit card score, a mortgage score, FICO 8, FICO 9, FICO 10, right? They're always coming out with different versions, but my FICO, it's a pay site. It's like $30 to join. You get a tri-merge. You could cancel at any time. That's the only place where you could get on the internet your mortgage score that I'm going to pull. So if you,
Gotcha.
Angela, if you do that today and your FICO's 5, 4, and 2 are a mid of 750, if I go pull it 5 minutes later, I'm going to get a 750. So what frequently happens is someone looks at their Credit Karma and says I'm 780, and I pull them in there 719 FICO
Right.
Classic. That old FICO Classic score is very harsh, very unforgiving. One paid collection from 3 years ago could still hit your score 50 points, whereas the new models don't do that. So until we transition out of that model, you want to be able to know what's my mortgage score, not what's my FICO 8 or FICO 9, because that's not what we
Right.
pull.
Yeah, I think
So get your credit in order, make sure that you have your cash and your reserves and your closing costs, right? Um, and we can help with that, right? If you're coming to us and you're saying, I'm buying a 250 house, here's the tax, here's the insurance, we'll do a fairly accurate loan estimate that's going to show you here's the cash to close, including fees. Then I need 6 months reserves. Here's how much money I need, and then pad it a couple $1,000, right, for incidental. So you want to make sure you have your cash. You want to make sure your credit is in order. And then you can go and look. And when you're looking, they're going to want to send you these addresses and all the numbers so you can see what if they're looking at 10 houses in St. Louis, let's say, which one's the best rental, right? Well,
right.
you'd have to run the numbers to figure that out, right? Maybe one is a 1.3 DSCR and one is a zero point 0.9, but you don't know until you run them. So doing your research up front can really help. And that's what we're here for, to kind of point them in the right direction.
Yeah, definitely. And that's one of the things I teach through some of my videos is, that mortgage loans are a lot like taxes, and no two scenarios are ever going to be the same. And there's so many different
Yeah,
factors that play in. Yeah.
yeah,
Um, so what trends are you seeing right now in the investor market? You kind of covered that some of them are, the markets are dropping in some areas nationwide. Is that
right.
the
I mean, yeah, some are staying flat, some are modestly increasing. But one thing I would say about investors is investors are always doing something, right? If
right?
you're 35 years old and you have a 10-year plan to acquire 30 rental properties, that's three a year. You better be out there hustling trying to find these, right? So when markets retreat, that's actually a buy signal for investors because we've
Yeah.
had such inflated markets, which stops investors from buying. Investors are looking for deals, right? What causes an investor to be able to get a deal? It's a motivated seller, right? Oh, Granny died. We need to get rid of this house. Or, there's 100 different life reasons why you can get a real estate deal. But when there's a ton of inventory out there and few buyers because rates are higher, that's investors feast on that. They go, I don't care if the rate's 7 or 7.5 today. I'll do this loan. I'll keep it 3 years. I'll refinance it when it's available. So investors are just much more active with their financing than consumers are. And rate is not really that kind of issue it is with a consumer where, their DTI is going to go over if the rate goes up a quarter. No, that's not how investors behave. The investor behaves as, what's my payment going to be? Can I make this property work now and then refinance it later? So in terms of they're always doing something. What they're doing depends on the specific geo market they're in, their strategy, all those things. But investors never stop investing.
Yeah. Um, so if you could give one piece of advice to someone who wants to build wealth in real estate, what would it be?
Well, you have to get started, right? You have to take action, and just like anything in life, I mean, you could talk about it and talk about it, but action is action. So, what are you doing today to find that rental property? Do you have your credit in order? If not, what are you doing to fix that? Do you have money to put down on the house? There is no 100% financing in this world, despite what a lot of gurus would have you believe. In the real world where I live, where loans get closed, you have to have good credit, you have to have money, and you're out there identifying the right opportunity. So if you bring us the opportunity, we can filter it. We can show you, is this the opportunity you think it is in the real world? Is it going to work as a rental property, right? And after we close, it's up to you. You got to get the tenant in there. You got to keep your property, do the upkeep. You got to take the call at midnight. The toilet just blew up. That sort of thing. That's on you.
I've
I
been
just give
there.
you the money. You handle all that stuff. So the but in terms of long term wealth, there's nothing else that matches real estate over a 50-year time horizon.
Right.
So the best advice is get started when you're young and don't wait too long. If you think the market is inflated, where's it going to be in 10 years? It's just like the stock market, don't buy it at an all time high. Okay, well, where's it going to be in 5 years? Where's it going to be in 10 years, right? So when you're thinking on a longer time horizon, these short term things tend to iron out. You have to look at kind of the historical record. Why have more millionaires been minted in real estate than any other field? Well,
Right.
because it's an asset, right? It's a hard asset.
Yep.
It's not an ephemeral asset. It doesn't typically depreciate. It may depreciate over a shorter time horizon, but on a longer time horizon, they're not making any more land. So
Right. Yep. Well, John, thank you so much for joining us today. You've answered so many
you're welcome.
questions.
Yeah.
I know that there's a lot of people out there that are thinking about investing and just not
Hmm.
sure where to get started. And I'm
Yeah.
sure this has been really great information for them. Um,
Good.
so would you mind if we brought you on again in a later
Sure.
episode? Okay.
Sure. Of course. Yeah. That's what I'm here for. I'm here to spread the gospel of the DSCR loan. And, over the last 10 years, going from none of my investors knew what it was to today, where every Tom, Dick, and Harry large mortgage company is out there advertising it. The investor acceptance, is growing and growing. There's still a lot of investors out there who do not know about this loan. So we still need to get out there, tell them it's available. Once they do one of these loans and they see how easy it is compared to what they're used to, they come back and do it over and over. So it's kind of like opening investors' eyes to the availability of financing when they're building a rental portfolio. So, yep,
Yeah.
get out there and tell all your borrowers we're here, we got money. We'll lend it out to them.
Yeah. When I used to invest back in the olden days, as my grandkids would say, we didn't have DSCR loans or fix and flip or
No,
renovation. We didn't have anything. So
right.
these loans just seem amazing to me. And
Yeah.
I really think that it can, be a game changer for some investors once they
Sure.
understand these programs and, it can help them grow a lot more rapidly. So, but thank
Yeah.
you again, John. I really appreciate it.
You're very
And
welcome.
Thank everybody for watching. I hope this gives you guys a better understanding of DSCR loans, and be sure to share with anybody that's thinking of investing. If you have any questions, feel free to reach out. Please hit that follow button so that you don't miss anything and so that our channel can grow and reach more people out there.